After covering these ratios, the liquidity ratios, the solvency ratios, let's go into a recap exercise to see what did we learn today. Let's start with the first question. When computing common size ratio for your company's balance sheet, were percentages for asset categories based on total assets? Were liabilities percentages based on total liabilities plus owner's equity? Well, just to refresh our memory, for common size ratios, for balance sheet common size ratios, always we use the total asset as a figure to calculate the percentages of each asset category. When it comes to the liability items, on the liability items, to construct the common size ratio, we can use the figure of total liabilities plus owner's equity, and as much as we can use the total assets, because remember the formula, total assets is equal to total liabilities plus owner's equity. So for the common size ratio, you can use the figure of the total assets, or you can use the figure of the total liabilities plus owner's equity to construct any common size ratio on the balance sheet, whether it is an asset category or a liability category. Second, what does the current ratio you computed for your business tell you about your company's ability to meet current liabilities? As we said again, to recap, the current ratio is the current assets over the current liabilities. Remember that this ratio, according to studies and statistics, it should always be around 2 to 1, which means I have to have on my balance sheet twice as much current assets as current liabilities. This way I will be able to pay for my current liabilities and have a safety net as well. Number 3, is your quick ratio between 0.5 and 1? If not, is there an explanation on that if it is satisfactory to you? Well, a quick ratio is nothing but the current ratio minus the inventory. This ratio of current ratio that as we said should be 2 to 1, on the quick ratio it should be 0.5 to 1. On the 1, we are on the safest side. We have enough cash and account receivable. Of course, we're talking net account receivable after taking into consideration the non-paid or potential non-payment of this account receivable. If I have a quick ratio of 1, reducing or deducting from the current ratio the inventory, this figure of 1 means that I have enough cash to be collected from my account receivable to pay for all my current liabilities. Of course, it depends on the type of the company, on the nature of the business, and on your plans, how much you're planning to have in terms of quick ratio or even current ratio, as we said before. When computing the sales to receivable ratio, how much sales you have as a percentage or as a ratio over receivables? Did you remember to use net sales and net receivables? Remember, if you use the figure of sales by itself, the gross sales that we have, and the gross amount for receivables, this might be misleading, since some part of sales, we did some discount of them. Some items of sales have been returned, so we have to take into consideration that the figure of sales that we have has some items that has to be deducted, such as the returns or the discounts. Whereas the receivables, if we take the figure of gross receivable in itself, again, this might be misleading. because some of the receivables will not be collected. These will be non-performing receivables. These will be amounted dues that are not turned or transformed into cash at a later stage. I have to take them into consideration in order to be honest with myself in my ratio analysis. The net sales, exactly how much I did in terms of sales, and the net receivables, exactly how much I'm expecting to collect out of these receivables. And as we said, this figure is very important, sales to receivables, to know how much I have cash sales and how much I have non-cash sales that need my attention. And last but not least, does the net sales to working capital ratio that you computed make sense for your business? Does the net sales to working capital, do you have enough working capital on your business? Do you have a lot of cash on your business? Do you have excess cash in your business from the sales? If your sales are high enough, so that ratio will be high. You have to be careful here again. If the sales are high and the working capital are low, this ratio will become very high. It means that you have not enough working capital to meet your demands. If sales goes down, if you have a sudden impact on the sales and the sales will go down, so you will not have enough money to pay for your liabilities. So you have to be careful always to strike a balance between how much this ratio should be in the industry and of course with your direct competitors.